In business tonight, Thailand's central bank trimmed its key interest rate to the lowest level in 2 years in a bid to boost growth. It is the fourth cut in 10 months and a decision widely expected by analysts. The Bank of Thailand brought the rate down to 1.5% with a 25 basis point cut with its latest move. The central bank had held the key rate at its June meeting, following back-to-back cuts at reviews in February and April. The BOT is expecting economic growth to slow in the second half of the year due to U.S. trade policies, as well as a decline in shorter-term tourist arrivals. The Thai baht gaining a little against the USD after the rate decision, trading around the 32 mark. And for more, we now speak with Erica Tay, Director of Macro Research at Maybank Investment Banking Group. Ms. Tay, thank you so much for joining us. So the Bank of Thailand cutting its benchmark rate by 25 basis points to 1.5%. What do you think were the key drivers behind this decision?
So very clearly, this was a widely expected decision, and I think it says it all that this was a unanimous vote by all 7 members of the Central Bank's Monetary Policy Committee, and I think it's based on 2 main factors. So GDP growth in the first half of the year held up quite okay because of the front loading of exports to the US, but growth in the second half is expected to see a huge step down to below 2%. And this is primarily because of the payback from the earlier export front loading and also a slump in tourism arrivals. So tourist numbers have fallen by some 6% in the first 7 months of this year. And this is before the military confrontation with Cambodia occurred. So we expect some further spillovers there, with some tourists perhaps deciding to stay away. So all in all, growth is not looking good, and inflation as well. It's below the target, and in fact has come in below 0 in the past month. So we expect inflation to continue to undershoot the central bank's inflation target of between 1% to 3%, both this year and next year.
As you said there, headline inflation has remained subdued. But how much of this is due to domestic demand weakness versus global factors?
So we noticed that some of the reason behind the fall in headline inflation is indeed because of global oil prices tumbling, as well as a weather-related supply of food. So these 2 factors contributed to negative inflation in recent months. But something to take note is that core inflation, which strips out energy as well as raw food, also started falling in the last month. So this shows that indeed, other than external factors, domestic demand is also weakening.
And with U.S. tariffs adding to trade headwinds, which sectors do you think are likely to feel the most impact in the coming months?
So pretty much half of Thailand's exports to the US are made up of electronics and machinery. So we think that these 2 sectors will be quite hard hit by the tariffs, even though they have come in at 19%, which is in line with what the market expects. Also, another key export from Thailand to the US would be automobiles as well as auto components. Now we note that the other Asian exporters of automobiles, South Korea and Japan, had US tariff rates set at around 15%. So if the tariffs on Thailand are higher, this puts Thai autos actually at a disadvantage.
And we know that a new BOT governor will be taking up the role in October. With the new appointment and leadership, should markets be bracing for any major shifts in monetary policy?
So we expect the Bank of Thailand to cut its interest rates one more time by 25 basis points this year in October. But this is less due to who is in charge at the central bank rather than softening of the economy fundamentally. So we think that a slowdown in the economy and inflation will lead the central bank to independently assess that a rate cut is needed. That said, we understand that the incoming central bank governor, Vitai, he has publicly said that he hopes monetary policy can work more closely together with fiscal policy to support the Thai economy. So with that, I think it's quite reassuring. So if the economy does weaken further in the next year, I think we can see that the central bank is open to further easing.
But having said that, Ms. Che, there have been questions over the central bank's independence. How would this influence investor confidence and effectiveness of future policy moves?
So I think we have to take a step back and remember that not cutting rates is not necessarily a sign of independence. So the Monetary Policy Committee is actually made up of 7 members. So I think we can be fully confident that the committee will still vote based on an independent assessment of the growth and inflation dynamics.
All right, Erica Tay there from Maybank Investment Banking Group. Thank you.